we'll get started with our first lunchtime keynote with Amy Hood, CFO of Microsoft. Before we get started, I have a lot of safe harbor to read. Okay, from Microsoft. Microsoft may make some forward-looking statements during this presentation, and you should refer to their SEC filings for the risk factors related to their business. This is true whether you're here in person or listening on the web. From Morgan Stanley, please note all important disclosures, including personal holdings, disclosures, and Morgan Stanley disclosures appear on the Morgan Stanley public website at www.morganstanley.com/researchdisclosures or at the registration desk. Excellent. So with that out of the way, Amy, thank you very much for joining us once again.
Thank you for having me.
So there's been a lot happening in Microsoft over the past year since we've been talking on this stage. I guess the biggest one being the addition of LinkedIn, but there's also a lot more subtle changes like improved gross margins. Can you walk us through your perspective on what have been some of the biggest changes we've seen in Microsoft over the past year, and what are you most excited about going into the next year?
It's interesting. I think maybe what you perceive is a lot of changes. I would probably describe as just accelerating a bit on the vision that we've had as a team. Strategy hasn't changed. Our ambitions haven't changed. Our goals haven't changed. I think in many ways the only thing that you've seen is probably a bit more aggression in that transformation to make sure we're accelerating through it, which is an important phase. I think with confidence comes some acceleration.
Right.
I'm trying to think, Satya, it'll be 3 years for him this month, and it's getting close to 4 for me. And with that, I think some stability and excitement about the future and confidence in what we can achieve, and that's probably what I would say.
Got it. When I talk to investors, the area of the story that I spend the most time on is intelligent cloud. And I was going to say that there's one fundamental debate I spend the most time talking about is server and tools versus Azure. So maybe to start with the conversation, server product revenue had a really nice quarter last quarter, up 7% constant currency. How do you think about the durability of that on-premise portion of the business longer term? Is this something that could sustain over the next year, over the next 3 years?
It's interesting. I know people tend to focus on the componentry, and I tend to focus on the all-up server products and services number for many reasons. Number one, that all-up number takes out the temporal impact of the timing of a transition. Non-annuity this, annuity that, cloud this, on-prem that, hybrid, different mechanisms of licensing. And so for me, the long-term goal is quite clear, right? To build a hybrid server business, server and services business that's primarily annuity-based. Mm-hmm. And so with that, the number, so the KPI of server products and services tends to resonate and be the cleanest. There will be many customers and in many geos who run the server products on-prem longer than others for various reasons, regulatory, geopolitical, et cetera. And so worrying about the pace of the transition is not a thing I spend a lot of time on, frankly. I spend a lot more time making sure we have the capabilities, both for our, and most of our customers are hybrid customers, so for hybrid solutions or cloud solutions, to be as capable of supporting the company's journey that they want to go on, not our journey we want to go on. Right. And I think that's probably better suited to pleasing customers. And so I tend to focus on it all up. This quarter, it was good. We talked a little bit about the fact that the SQL and Windows launches both actually went a little better than we thought. When that happens, you do see that on-prem KPI be a little better. But over the long term, the most important thing to me is to continue to pivot it to an annuity business, which is long-term commitments by customers to our platform and our products, and then continue to really break new TAM ground with many of the cloud solutions.
Got it. And I think that's a good segue into sort of the second part of the question that investors have is when you sell a workload into an on-premise environment versus selling into a cloud environment, how does the opportunity, the monetization opportunity change for Microsoft? Are you going to be able to make up, in terms of broader monetization, what you're losing in what was a hugely high gross margin business in on-premise?
Well, it's why I think we focus so much on dollar profit growth, right. Whether that's at the gross or the operating line. Because, number one, you're right. If you just said like for like, if you sold the exact same server standard SKU and somebody chose to run it in the cloud versus an on-prem, there's clearly a distinction in the cost that we would bear. But that's not actually what's happening. Instead of selling one, you sell 1.3 or 1.6 or 2 point some number multiple of that in terms of new data needs, new workloads created, new opportunities for compute or insight. And so while the one-for-one substitution would clearly not be as interesting, it's just not how the world's evolving. Right. The pace of the opportunity growth, the pace of that expansion, it's, I think, sort of a once in a every decade construct, maybe, right. Maybe longer.
And can you remind me about the framework of what percentage of customers coming over to Azure, what percentage of that is kind of net new business versus existing business transitioning over?
It's hard to say one for one that you know that this file print server that used to run on-prem is now being run as a file print workload. It's not exactly how the math would work. Mm-hmm. So the way I tend to think about it is look and say, hey, you know, top line revenue's been growing double digits in that server products and cloud business. Margins are getting better all up. We know the market's growing. We know we're taking share within that. And so overall, I tend to feel pretty good as opposed to do a one-for-one like switch.
Got it. And then on the competitive environment, when we're talking about that sort of global scale public cloud utility, if you will, most people talk about Amazon Web Services and Google Cloud Compute being the big vendors in that space. How do you see that competitive dynamic having shifted over the past year? How do you see that evolving on a going forward basis?
You know, I think maybe the distinction in a year later is less in those three players who I think were there before and continue to be there and quite aggressive as you would expect. And maybe it's some of the people that have entered a little bit later. I think the IBM cloud gets a lot of mention with very large customers. You see that both in the press and in some of the workload solutions they've talked about. Would probably be, Ali is incredibly successful across both China and other very large, interesting markets globally. And so I often say it's not the three, although I think you would put them in the clear leader camp. It would be actually that from a global perspective, there's probably even more players than the three that you've seen a year later.
Got it. It's interesting that you bring up IBM because I think one of the differentiations that I often talk to about Azure versus a AWS or a Google is the fact that you guys have an install base, that you have a broad distribution channel like IBM does, has an install base. Has that advantage, that sort of install base advantage, has that become more so an advantage over the past year as people move from that net new environment, new workloads, to more thinking about how we're going to be doing that hybrid environment longer term?
Yeah, I think the distinction may in fact be twofold. Number one is we've really always been hybrid from the start. We ourselves run a hybrid environment inside the company. Most of our large customers have asked for that from the beginning. And so I do think that that's sort of just how we're built architecturally and from a customer centricity perspective. The other thing about having an installed base is really the customer connection and relationships. Our enterprise sales force, I think, has been underappreciated in its transition from really selling what we would think of as desktop-based workloads, selling Windows and some version of Office, through to selling really full infrastructure stacks, IaaS, PaaS, and SaaS. And the transition to do that and the capabilities, I'm really proud of that group and all they've done to transition that without really adding. We've added some sales capability at the technical high end. Most of it has been retraining and new job skills.
Got it. One last quick question, then we'll shift gears to productivity and business process. Amazon recently lowered prices. You guys recently lowered prices. How should we be thinking about that on a going forward basis? Sort of just the pricing dynamic going on a go forward basis.
There's been a pricing dynamic there for many, many years at this point. I think you should think it's a competitive market. All of us tend to want to move up the stack in terms of adding premium services. Our premium services are growing faster than the core business for us. Part of that is volume. Part of it also, obviously, would be the impact of price. You don't see the same impact at the higher end where there's more differentiation or maybe more commitment on analytics or insights. And so, I don't describe the pricing dynamic as something that is new or that I would think to be temporal. But I do think what you'll see is, an effort to continue to move people up the stack in terms of capability. You're not just really running, you don't want to be in the business of running, I think, just core storage and compute.
So more and more the value goes up the chain.
Yeah.
Got it. So shifting gears to productivity and business process, I think the biggest change, obviously, since the last time we've spoken is that now LinkedIn is in that overall business. Where and when should investors be looking to see the initial sort of benefits of bringing LinkedIn on board and having LinkedIn part of the Microsoft ecosystem?
I think you'll start to see the earliest benefits probably in the co-selling of some of their what I would call business solutions. Mm-hmm. You may have noticed in Satya's comments this quarter, he really grouped LinkedIn along with our Dynamics business in terms of how to talk about the offers. You'll see, I think, the Sales Navigator product, which is one of LinkedIn's core products, have some and find some added benefit in having our dynamic sales force be able to sell that as well. I think our ability to leverage each other's sales forces for some of that work will be a good thing and quite tangible in terms of adding quota is not the most complicated change to make in terms of integration. The next places you'll start to see it will be in Office in terms of some of the integrations and insights that you'll be able to learn through Outlook or some of the experiences if you're running the modern clients. And when I say modern clients, I mean Office 365 Pro Plus, which is what we call the subscription form as opposed to the pure client perpetual licenses. You'll see some of the first integrations come there. The pace has been quite encouraging. We meet, I think it's once a month to go through the technical roadmap, integration roadmap together. Their former head of engineering, Kevin Scott, is now the CTO for our company, which I think is a great decision in terms of integration and being able to do product roadmaps together. He's already made a big impact, and we enjoy having him in our meetings on Fridays. So, I think I'm pretty excited about what's possible, both with the Dynamics business, but also in the broader Office business as well. It's growing their core. I mean, the business is growing quickly. First thing, rule of Fight Club, is that what they say? The first rule of Fight Club. It's sort of just don't mess with it. You want to keep the core growing. And they're doing a great job of that. The team's good. They are motivated. Jeff's a great leader. He's inspiring to be around. So, it's good.
Got it. Speaking of don't mess with it, the other side of the equation is the potential for cost savings. And I think investors have thought about potential cost savings ranging from being able to run their application on your back end, about savings through distribution, and now Dynamics CRM is much more of a distribution channel for them on a going forward basis. How should investors think about the time frame for achieving those efficiencies, or should we be a little bit more cautious because
you should assume I'm not focused on it.
Okay.
I'm focused on growing the top line revenue and accelerating that business and its potential with ours. To add more customers, to increase their impact, to have it grow faster, to accelerate our business, to have the integration and technical integration to deliver customer value go well. We will do the smart things in terms of sharing quota. You would call that a cost synergy. To me, that's a revenue generator. Can we do and share accounting teams? I'm sure we'll can and will share accounting teams. We'll have one internal audit team. It's the smart things will happen. We're pretty good at that type of activity, and I'm just deeply, deeply focused on driving revenue growth.
Okay.
This deal was not done for cost savings. The deal was done to drive the top line.
Perfect. Shifting gears to Office 365, particularly Office 365, the commercial side of the business. I think last quarter you had 49% constant currency growth. By our calculations, this is becoming one of the biggest drivers of gross profit dollar growth within your overall business. We're trying to understand sort of where this fits in the broader sort of path to $20 billion in commercial cloud that you guys have been talking about. So really on two sides of the equation, price and quantity. When it comes to price, where are we in that kind of SKU uplift? We have that tiering, E1, E3, E5.
Yes.
How far along the path have we gone?
It's interesting. We talked about we're about 60% premium mix in our E-suites. But what's interesting about that is it really talks about E3 as being premium, even though we've now got versions of something E4-like and now E5-like with security analytics and voice, PSTN conferencing in the higher SKU. And so that 60% we've talked about is really primarily the mix from E1 to E3.
Okay.
Most of the ARPU lift that you've seen over the past 3 years is primarily attributable to that first mix shift to the E3 SKU. And so there's lots of room for us to continue to move people even further up the SKU stack, to also add standalone components like analytics have actually done quite well standalone, as have some of the security components. And then move them to E3 as well. So I think Chris and I have been talking about this, do I need another metric? Because it's sort of premium. It's just, we'll continue to add tiers. And so E3 probably won't seem quite as premium anymore as we continue to add layers in the stack.
Got it. And any color you could give us in terms of what are the core functionalities that are pulling people up the stack? Is it analytics? Is it security? Voice is something we're starting to hear a lot about.
Right now, I would say just in terms of both business decision makers and CIOs, both analytics and primarily security tend to be the pull right now into that upper E5 SKU. It's top of mind for everybody. It tends to actually be quite price competitive to its peers in terms of value, both on a standalone basis and then if you were to buy the SKU, giving you optionality into other workloads as you see fit. It's still pretty compelling as a bundle/suite. And so I would probably say stack ranking them, security is the biggest pull currently, then probably analytics. Voice is always going to be a trailer. It's a more complex workload. You're less likely to deploy it sort of all at once across all your seats. So it tends to be something people opt in through branch and other deployments. But we've been encouraged. Obviously we run on it, but we've been encouraged by large deployments.
And just double-clicking real quickly on that analytics note, analytics is something we've talked about a lot over the past 10 years with Microsoft. And it seems like Office 365 has been a vehicle that's really starting to sort of enable that distribution. Is it just that? Is it just a much better vehicle for enabling distribution, or is it really sort of where the products come, where the markets come?
I think it's a lot of things. Most analytics solutions required a near PhD to operate for a long period of time. And so when we kept seeing the optimism around analytics, I actually think some of the solutions were still pretty complex in terms of being able to bring that type of insight down to an ease of use that's more similar to Excel. Most people still use their number one insight tool and analytic tool continues to be our Excel product. And so the more you have our solutions like Power BI or analytics inside SQL databases look and feel from a user and integration perspective more like Excel than less like Excel. I think the more you'll find that broad-based coverage analytics type solutions will be more interesting to people.
Got it. And then on the Q side of the P's and Q's, in terms of quantity, where are we in terms of the base migration?
Yeah.
And we'll start with that. I think you've given some signposts along the way. But how far along, and particularly when we get to some of the regulated industries, like guys like Morgan Stanley, are they coming close to sort of coming on board with Office 365?
Let me take the first question and then the second on regulated industries. The first question, which is where are we in the queue? I guess about 2 years ago, seems like just yesterday, Chris, we had the analyst briefing. And in that, I showed like an install-based chart. I can see it in my mind. And we talked about the path we were on with the install base of Exchange in particular. We talked about Office as well. I feel really good about the projections we laid out nearly 2 years ago and where we are today in terms of both install-based growth and the penetration of the install base in the transition. So both components of that queue I feel quite good about. And you say, well, where's the queue coming from, the net queue as opposed to the transition queue? The net queue tends to be still coming from the small to mid-sized customer segment, often people who couldn't afford the capital expenditure up front to deploy some of these solutions. The other place has actually been adding, the term is odd, we call it a deskless worker, but adding some of the employees, even in large enterprises, where one-to-one computing constructs didn't exist in the same way in terms of a PC. And so we've actually seen decent coverage of those, especially for the non-Office components of the suite, Exchange, SharePoint, and some of the comms components. So that's been the other big queue overall driver. And then the install-based transition, I think, has gone actually pretty on plan is the term I would use, maybe even a little better than we had hoped.
Got it. And then to the regulated industries.
Sorry. I think this is interesting. It's a little bit like those CIO surveys you guys all do. You every year or every 6 months ask people, do you have any intent to move to the cloud? And there's sort of the adamant, I'll never do it. But the I'll nevers tend to go down with every CIO survey. I tend to think regulated industries, we're seeing that transition. The level of security insights, the level you're seeing, and actually geopolitics play an interesting component for regulated industries as well. We run different models. Germany, we have a tenant-based model. We've got a different model in China we run through a company called 21 Vianet. We've got owned and operated data centers as well. All of these are meaningful components to moving regulated sort of industries, I would say, further. But I tend to view it more as a time series as opposed to there's one day that everybody will decide today's my day. Tend to move different workloads over time. And so, I don't know, I remain hopeful about FinServ.
Got it.
As a person.
We're working on it.
Yeah, you guys are working on it.
I got a Surface tablet right here. Different division. In terms of the quantity question, is piracy becoming a part of this at all? Or is Office 365 helping to winnow that down at all, or is that still?
So interesting. I get asked that a lot. I do think in certain geos, it's never, I think it's probably, it resonates funny. I don't think of it as, I now have an anti-piracy product. I think about it more as what value can you put in a subscription such that paying for it feels like good value. Yeah. And I do think we've made some progress on that front, specifically in some of the geos you'd expect. We also, frankly, had a lot of piracy. It's not just geo-based. Many people pirate and don't know, frankly, that they are. And so a lot of the small and mid-sized businesses in particular tended to have piracy challenges. And I do think you could think about that. It's not the language I would normally use, but it is certainly a way to think about it in terms of adding paid SMB growth could be a little bit of a proxy for that.
So perhaps under licensing more so than proxy.
Under licensing would be a preferred term I would use.
All right. Last segment, more personal computing. This is an area that I think a lot of investors, I don't want to say don't focus on, but don't think of as a area of potential ads anymore. But that being said, the Windows OEM business has been growing single digits over the past couple of quarters,
yes.
And a lot of that's come from strength in the commercial side of the business.
Yes.
Can you sort of give us an update on where are we on that Win 10 cycle? What's the ability for that commercial cycle to grow that overall Windows OEM business?
I'm happy you asked me about Windows. You seem to not get asked about it very often. And you're right. I do feel like people, either I'm not telling the story well enough, which I take as feedback because nobody asks, or I think you're right. Over time, people just began to focus on our big investments and big growth returns, and that has been, frankly. And we set ourselves up for that by talking about the commercial cloud target, and I think all the energy, frankly, externally, and we have a lot of internal energy on it to get to that goal. Windows is really interesting. Windows 10, when it launched, and we did the free upgrade process primarily for consumers, we were really encouraged by how many and the types of feedback we were getting. But more importantly was the feedback we were getting from commercial customers. Right. The security value prop and the management value prop of Windows 10 is clearly resonating. The number of proof of concepts, the number early deployments, the number of transitions, what I would describe as pull as opposed to push in terms of customer demand. We clearly feel it inside the enterprise for Windows 10. Our deployment has been encouraging, especially in the way you would see that. We tried to change the KPI in the summer to be more similar. So you had we do the Office server services and product KPI, which is the combination of on-prem and cloud. Mm-hmm. Do the same thing in the server one, and there's a new one, Windows Commercial Products and Services. It does the same thing. It basically takes the volume licensing component of the Windows, which would be on-prem, and adds some of the cloud components, like advanced threat protection and other SKUs, which you would hear us call, believe it or not, we have a Windows E5, just to make things confusing. But from customer perspective, it's easier to name things the same. Those things all go into that metric. That metric's been growing, I think, 6% this last quarter. It's a combination of excitement around Windows 10, the security value prop, the commitment I think companies are making. And I do think you're starting to see it in terms of OEM commercial demand. Right. I think you've seen it in, I think, the industry in terms of shipments, PC shipments. And we should and have, in the commercial business, tended to be around that number. We're slightly higher than it right this minute, but it should trend pretty close on the commercial side. But yes, we are. I'm very encouraged. And you have to understand, when you sell Windows, what you're really selling is a modern desktop environment. The modern desktop environment also allows us to talk to customers about why you should be on modern Office, why you should be upgraded to the most recent solutions. Number one, many of our customers own them. Number two, when you upgrade and deploy on the new Windows version, you should and are more secure. And I think it's allowed us to sort of expand the dialogue beyond you need a new PC with a TPM chip. It's now you need to run a secure environment. And these are the components of doing that, which I think you're starting to see.
Got it. Want to make sure that we talk about CapEx and some of the balance sheet items as well. When we think about, you made some comments last summer about the growth in CapEx spending having peaked. Can you help us understand sort of where that comment comes from? Is it a utilization comment? Is it a build-out comment? Is it just in terms of sort of how you see the end demand working out?
It's definitely not demand-driven. What I mean by that is demand seems to be there. Mm-hmm. So it's far more driven by infrastructure improvements. I mean, it's actually both twofold. We talk about efficiency improvements. One is just the software and continuing to invest on the software side toward increasing how much stuff you can fit in a unit of things. And so we spend a lot of time seeing how much stuff we can jam into a unit. The other concept is how cheap is a unit, right, of a thing. That's also sort of the Moore's Law construct, but it also happens when you standardize all your componentry across a very broad business. So not only are, in certain instances, hardware prices coming down, not everywhere, in some places hardware prices are coming down, when you run workloads that are everything from search with Bing all the way up to very high-level AI Azure SKUs, and you're able to run them on a consistent architecture, your costs just come way down. I'm not dual sourcing a piece of network equipment, right? And so think of it almost as supply chain improvement. Right. Is sort of a simplistic way of thinking about it. All of those things have actually been encouraging. We're in most geos, which I think is another aspect to your question. That being said, we're not laying down a bunch of concrete in advance of needing it. So even though you're in a geo, you still got to lay down more concrete pads and water cooling systems as you need it. We're not building that stuff in advance. So while I think people are like, oh, you must be everywhere in the world, aren't you done buying land, or aren't you done hauling away lots of dirt? No, we're not. It's just you more can be just in time, so I don't have a long lead in terms of the spend versus seeing the demand curve, which is a good thing. It just brings your working capital issues down.
Got it. And I'm going to sneak in one more before I open up to the audience. Probably the second most often question I get from investors is the sustainability of very low OPEX growth. You guys have been talking about that, sort of moving from underperforming investments into better performing investments for quite some time. Is there still meat on the bone in being able to do that?
There's always, this is funny. I get asked this question so often, I'm going to cover off all forms I get it asked in. Number one, do you solve for zero? No, I do not solve for zero. I don't solve for it. I don't think about it. It's not the frame I use, so that's the best way it gets asked. It's like, do you just sit there and circular reference your way into zero? No. Do I solve for inflation? No, don't solve for inflation. Don't solve for a number. I will tell you, what I solve for is the ROI of every single one of the $31-ish billion in operating expense that we spend. While if you ask anybody at Microsoft, could they spend more money, all of them would say yes. All of them, right? They should say that, right? They should say, yes, I have so many terrific, innovative, interesting, awesomely impactful ideas that you ought to give me more money. And they all say it. I love that. I love that energy, right, that comes with that. And I listen to some really fascinating arguments. Some are terrific, some are less terrific. But the energy to grow is what I care about. Then my job is to take those dollars, every one of them, and ask myself if we're putting it in the right place and on the right time horizon. From what I would call horizon zero, which is like right this minute, do we have the right promo in place? Do we have the right SKU pricing? Do we have the right channel incentives? All the way to horizon 3, which is much more like research-based work, done out of our MSR, Microsoft Research facility. Some of that looks very academic pursuits to many. Deeply important. It's what kind of, I think, made us the leader in some technologies like FPGA and putting that into data centers. So the answer is, if I feel like it can drive top-line revenue growth, if I feel like the return on both actual ROI of the dollar or the return on the invested capital, which is another dollar we spend a lot of, is above the hurdle rate, we have the competencies to achieve it, we're going to spend. And so I kind of never know what that number will be until I feel like I've looked under every pillow cushion and found that there's nothing left for me to find. Right now, when I lift up the pillows on the couch, there's still some pennies in there, and we can move them. And the market changes, right? You know, you can always retrain teams. You can move salespeople. Geos sometimes aren't as healthy or are as healthy. You can move salespeople. You can change incentive plans. And there's tons of mechanisms to use. And I think we've grown far more sophisticated. And I think what you always want to keep in mind is you never want some worldview on OpEx that's very short term to dictate the amount of ambition we have. And I would say the ambition that we have is high. And our ability to achieve it is really good. And so the confidence with which you spend money changes when that environment looks that way. Okay. That being said, people would probably say I'm cheap. And so it's okay. I mean, that's what you CFOs should be. They should think I'm tough and difficult and kind-hearted, but like 65% of the time. But, you know, that's my job, is to keep you all in mind and have a high bar. But it doesn't mean I'm solving for zero. Just everybody's squared away. Doesn't mean it won't be zero. Just means I'm not solving for zero.
So a couple of minutes to take a few questions from the audience. Do you have any? Okay, perfect. So I wanted to ask this question, and we could get our time in. You
have to be fast with Keith.
Exactly. When we think about capital return,
yeah.
Right? People ask me about the durability of sort of capital return, given that you have to take down debt in order to do it. And one of my favorite quotes is from you saying, hey, as long as people give me dollars at 2%, I'll keep buying back my 3% dividend yield stock.
Yeah.
Your interest rates are coming up, and interest rates overall are coming up. So is that dynamic going to be durable over time?
Let me say these things. While I'm proud of my AAA rating, it's not a thing I solve for. We just were back in the market raising debt. And so, you know, I think I've always viewed the return of capital as a priority. We've been returning in excess of our free cash flow and far in excess of our free cash flow, a couple years at this point. The commitment that we made at the board level and from Satya and I was to bring down the net cash balance of the company and return it to shareholders, both through buyback and dividend, and we've done that. And I'm really proud of it. I think it was a great decision. And I think going forward, you'll continue to see a balanced view. We sort of accelerated the pace to get the balance down. I still view that as an important component, along with continuing to invest in ourselves and continuing to invest capital in growing the business. But it's not interest rate driven in the way that you're thinking about it per se. I mean, even if interest rates rise a little bit, you know, there's still room to borrow and have it make sense for us, and you'll continue to not see that as a constraint in my mind. Right. The math equation.
And just in terms of sort of on the political side of the equation, there's a lot of uncertainty around taxes and repatriation and the like. Does that impact any of your near-term decision-making on capital allocation? Do you wait for stuff? Do you try to...
This one's tough. We have been advocating for structural tax reform for many and varied administrations, is what I would say. This one we will watch. We will see what various proposals get discussed. And as it gets closer, if it gets closer and as it gets closer, we'll be able to tell you how it would impact what we do all day. In the interim, you know, we've not been a company to wait on tax reform to return capital. I mean, you've seen it. I mean, we've basically said it made sense to return capital. It made sense to buy back stock. We borrowed to do it. We haven't waited for structural tax reform. It's not been a reason to wait for me or for the board or for Satya, who cares deeply about the topic. I'm sure for others, waiting could make more sense. It's a more meaningful delta. But for us and our capacity to borrow plus the ability to invest in ourselves, I don't feel like we have to wait to be able to do any of the things that I feel super passionate about, which is mainly continuing to grow. And if there's ways to grow, I don't feel like waiting for this administration or any other. It's a good tactic.
Excellent. Well, thank you very much, Amy, for joining us. It's a great conversation.
Thank you, Keith. Thanks, everybody.